Hello, I'm Tino Cuellar, President of the Carnegie Endowment for International Peace. Today it's my privilege to welcome you to a special event. We're at the annual meetings of the World Bank and the IMF for 2022, and it's obviously a challenging and important year as we navigate the impact of security problems, sustainability, and the future of the global economy. Today's guest of honor plays a crucial role in helping the world navigate these currents. It's my honor to introduce Cristalina Gorgieva, the Managing Director of the International Monetary Fund. From its origins in 1944, the IMF has grown into one of the world's major institutions, capable of mobilizing over $1 trillion to help members improve their economies and achieve stability for their people. In 2019, Cristalina Giorgieva was selected to serve as the Managing Director of the fund, the first person from Eastern Europe and from a developing economy to serve in this role. Born in Sofia, Bulgaria, she holds a PhD in economics, and she's been a key official shaping economic policy and leadership roles in the World Bank, the European Commission, and of course as the leader of the International Monetary Fund at an absolutely pivotal time for the world. In a moment, I'll turn it over to Managing Director Cristalina Gorgieva to unveil the results of the IMF's biannual economic outlook. The world looks to this analysis to get a sense of where the global economy is and where it's going. It comes at a time of war, of inflation, of supply chain challenges, and ongoing effects of the COVID-19 pandemic. Following her remarks, she'll join me for a conversation about the outlook, the near-term, medium-term future of the global economy, and related issues. And after that, we're going to take a few questions from our global audience. Introducing Managing Director Gorgieva to this audience is now my honor and pleasure.
Thank you, Tino. It is a great honor for the IMF to partner with the Carnegie Endowment. Our institutions are committed to shared peace and prosperity, especially vital goals at this critical moment for the world we live in. To put it simply, we are facing a crisis on top of a crisis. First, the pandemic. It turned our lives and economies upside down, and it is not over. The continued spread of the virus could give rise to even more contagious or worse, more lethal variants, prompting further disruptions and further divergence between rich and poor countries. Second, the war. Russia's invasion of Ukraine, devastating for the Ukrainian economy, is sending shockwaves throughout the globe. Above all is the human tragedy, the suffering of ordinary men, women, and children in Ukraine, among them over 11 million displaced people within the countries, across borders. Our hearts go out to them. The economic consequences from the war spread fast and far to neighbors and beyond, hitting hardest the world's most vulnerable people. Hundreds of millions of families were already struggling with lower incomes and higher energy and food prices. The war has made this much worse, and it threatens to further increase inequality. And for the first time in many years, inflation has become a clear and present danger for many countries around the world. This is a massive setback for the global recovery. In economic terms, growth is down and inflation is up. In human terms, people's incomes are down and hardship is up. This double crisis, pandemic and war, and our ability to deal with them are further complicated by another growing risk: fragmentation of the world economy into geopolitical blocs with different trade and technology standards, payment systems, and reserve currencies. Such a tectonic shift would incur painful adjustment costs. Supply chains, R&D, production networks would be broken and need to be rebuilt. Poor countries and poor people will bear the brunt of these dislocations. This fragmentation of global governance is perhaps the most serious challenge to the rules-based framework that has governed international and economic relations for more than 75 years and helped deliver significant improvements in living standards across the globe. It is already impairing our capacity to work together on the two crises we face, and it could leave us wholly unable to meet other global challenges, such as the existential threat of climate change. It is a consequential moment for the international community. The actions we take now, together, will determine our future in fundamental ways. And it reminds me of Bretton Woods in 1944, when in the dark shadow of war, leaders came together to envisage a brighter world. It was a moment of unprecedented courage and cooperation. We need that spirit today as we face bigger challenges and more difficult choices. The global recovery was already losing momentum before the war in Ukraine, partly because of Omicron-related disruptions. In January, we cut our global growth forecast to 4.4% for 2022. Since then, the outlook has deteriorated substantially, largely because of the war and its repercussions. Inflation, financial tightening, and frequent wide-ranging lockdowns in China, causing new bottlenecks in global supply chains, are also weighing on activity. As a result, we will be projecting a further downgrade in global growth for both 2022 and 2023. Fortunately, for most countries, growth will still remain in positive territory. That said, the impact of the war will contribute to forecast downgrades for 143 economies this year, accounting for 86% of global GDP. Yet, as you will see in our World Economic Outlook next week, prospects vary greatly across countries, from catastrophic economic losses in Ukraine to a severe contraction in Russia, to countries facing spillovers from the war through commodity trade and financial channels. Economies facing downgrades include net importers of food and fuel in Africa, the Middle East, Asia, Europe. Higher commodity prices have lifted growth prospects for many exporters of oil, natural gas, and metals. But these countries are also impacted by higher uncertainty, and their gains are far from enough to offset an overall global slowdown, largely driven by the war. At the same time, higher energy and food prices are adding to inflationary pressures, squeezing real incomes of households around the world. Medium-term prospects have also taken a hit. For most countries, output is now expected to take even longer to return to its pre-pandemic trend. Most emerging and developing countries are not just grappling with the economic fallout of the war, but also the scarring effects of the pandemic crisis. This includes job losses and learning losses, costs borne mostly by women and young people. The recovery remains deeply divergent between rich and poor. On top of this, the outlook is extraordinarily uncertain, well beyond the normal range. The war and sanctions could escalate. New COVID variants could emerge. Crops could fail. Before the war, Russia and Ukraine provided 28% of global wheat exports. Russia and Belarus supplied 40% of exports of potash, a critical fertilizer. Now, grain and corn prices are soaring, and leaders across Africa and the Middle East are telling me that supplies are running low. Food insecurity is a grave concern. We must act now with a multilateral initiative to bolster food security. The alternative is dire: more hunger, more poverty, more social unrest, especially for countries that have struggled to escape fragility and conflict for many years. Food and energy prices, along with supply chain issues, continue to push up inflation. For advanced economies, inflation is already reaching a 4-decade high, and we now project it to remain elevated for longer than previously estimated. This is the most universally complex policy environment of our lifetime, posing tremendously difficult choices. How can policymakers rein in high inflation and rising debt while maintaining critical spending and building foundations for durable growth? The immediate priorities are to end the war in Ukraine, confront the pandemic, and tackle inflation and debt. We know from global experience that conflict is the enemy of development, the enemy of prosperity. The high cost of war has crippled and continues to cripple so many countries. As we hope for peace, we must do all we can to help Ukraine and all impacted countries. For our part, the IMF stepped up with $1.4 billion in emergency financing to help meet Ukraine's immediate spending needs. Last week, we also launched a special account that gives a secure way to provide further funding to Ukraine. And together with our international partners, we are preparing for the massive reconstruction effort that will be required. We are also actively working to support Ukraine's heavily affected neighbors, such as Moldova, a country of just 2.6 million people, which has already welcomed over 400,000 refugees. And we are stepping up support for the 20% of our member countries experiencing fragility or conflict. At the same time, COVID continues its deadly march. To fight it, we need a comprehensive toolkit that includes vaccines, testing, antiviral treatments. This should be deployed everywhere. Recent analysis from IMF staff and our partners shows that this can be done for a modest $15 billion price tag for this year and $10 billion each year thereafter. Surely, if we have learned anything from the pandemic, it is that health security is economic security. Just as important for economic security is tackling inflation. Inflation is a threat to financial stability and a tax on ordinary people struggling to make ends meet. In many countries, it has become a central concern, and there is a rising risk that inflation expectations could become de-anchored, which could make inflation more entrenched and harder to control. In the face of this challenge, central banks should act decisively, keeping their finger on the pulse of the economy and adjusting policy appropriately. And of course, communicating clearly. Emerging and developing economies face the added risk of potential spillovers from monetary tightening in advanced economies. Not only higher borrowing costs, but also the risk of capital outflows. To address these challenges, Countries should be prepared to use the full set of tools available. They range from extending debt maturities and using exchange rate flexibility to foreign exchange interventions and capital flow management measures. Helping countries nimbly respond in such circumstances is precisely why we recently updated the fund's institutional view on this topic. These country-level tools need to be coupled with international efforts to help economies move safely through the monetary tightening cycle. Maintaining access to liquidity is particularly critical. And this is where the IMF steps forward. Our lending, currently over $300 billion, has helped our members' countries significantly in this regard. And last summer's $615 billion SDR allocation did the same. Low-income countries are using up to 40% of their SDRs on COVID-related priorities like vaccines and other essential spending. But even with assistance, many policymakers face the difficult task of addressing rising debt. This is why spending must be carefully prioritized on safety nets, health, and education, and targeted to the most vulnerable. A credible medium-term fiscal path, including equitable tax policies, is key. It will help create the space needed to deliver this support without compromising public debt sustainability. For some countries, especially among the 60% of low-income nations already in or near debt distress, debt restructuring will be required. To help many of them, the G20's common framework for debt treatment must be improved with clear procedures and timelines for debtors and creditors. It should also be expanded to other highly indebted, vulnerable countries that can benefit from creditor coordination. Timely and orderly debt resolution is in the interest of both debtors and creditors. These steps alone will not bring a durable and inclusive recovery. For that, policymakers must stay focused on seizing the opportunity of the major structural transformations that are already underway. The two most important are the green transition and the digital revolution. As the most recent UN climate report highlights, the threat to our planet is not going away. On the contrary, it is getting worse. We must mitigate it everywhere, adapt where necessary, and build resilience against the shocks to come. We know what needs to be done. A comprehensive approach, including carbon pricing and investment in renewables, with compensation and new opportunities for those adversely affected by the green transition. These measures can also bolster energy security. The IMF is stepping up to help. Yesterday, our executive board approved the creation of a new Resilience and Sustainability Trust by providing affordable long-term funding and catalyzing private investment. It will help address macro-critical challenges such as climate change and future pandemics. The final global issue I will touch on today is the digital revolution. This includes reskilling workers for an increasingly digital economy, unlocking the potential of innovations such as central bank digital currencies, and strengthening the regulatory framework around crypto assets. Over 100 of our member countries are actively investigating this crucial area, and we are assisting with policy advice and capacity building. We used to say, the future is digital. Now the future is here, bringing new sources of productivity, growth, and jobs. Let me conclude. In the past 7 weeks, the world has experienced a second major crisis, a war on top of a pandemic. This risks eroding much of the progress we have made over the past 2 years climbing back from COVID. Add to this the growing threat of fragmentation into geopolitical and economic blocs. In a world where war in Europe creates hunger in Africa, where a pandemic can circle the globe in days and reverberate for years, where emissions anywhere means rising sea levels everywhere, the threat to our collective prosperity from a breakdown in global cooperation cannot be overstated. The only effective remedy to these risks is international cooperation. It is our only hope for a fairer, more resilient future. And it is our duty. With near universal membership, the IMF is a tried and tested platform for global cooperation. Drawing on the collective strength of our members, we are providing urgently needed policy advice and financing to those hardest hit by the double crisis. And we stand ready to work with our international partners to do even more. At the Bretton Woods Conference in 1944, US Treasury Secretary Henry Morgenthau laid out an elementary economic axiom to help guide the founders of the IMF. Prosperity, like peace, is indivisible. In today's more shock-prone world, the challenges we face are just as indivisible. Our efforts to solve them must be indivisible as well. Thank you.
Managing Director Gorgieva, congratulations on the release of this report. It's very important for the world. You and your colleagues here at the spring meeting are dealing with the war in Ukraine, among other issues. And I want to start by asking you to focus on how that sheds light on a process of real challenges for globalization. Many observers believe that the world is pulling back from globalization, a process that has affected so many lives around the world since 1944. And I wonder if your sense is that we are in a process of deglobalization, what that means for the world and what we do about it.
Even before the war, there have been trends of more fragmentation that come from the fact that the world today is much more diverse than it was a couple of decades ago. And what the war has done is to create new questions about the way we work together. For example, questions around the security of reserves and what composition these reserves should have. How do we make cross-border payments? These are very legitimate questions, but we have to remember that the answer need not be in isolation and fragmentation. Let's go back to 1990 when the Cold War ended and the world stepped into an era of rapidly increasing prosperity. What has happened since is, because of an integrated global economy, we have all become everywhere more prosperous. The world economy tripled, and the big beneficiaries have been emerging markets and developing economies. They have increased 4.5 times in size. And most importantly, the level of poverty in the world dramatically decreased. In 1990, somewhere around 2 billion extremely poor people. Today, the number is still very high, 650 million. But for 1.3 billion people, the integrated global economy was a pathway to better lives. So when I look at today's challenges, we need to just recognize that it is more complex, but complex doesn't mean impossible. And for this reason, we have to look at what are the challenges that unite us. Right now, food security, getting everybody in the planet the ability to feed their family. Going into the future, dealing with the climate crisis, but also increasing the opportunity for access to new jobs on the basis of technological advancements. For us at the IMF, there are two major priorities. One, to provide objective assessment of where we are, what are the scenarios ahead, so leaders can make informed decisions. And that has been our mission in life since 1945, to keep a hand on the pulse of the individual country economies and on the world economy. And second, to make our contribution in the areas of our strength, macroeconomic financial stability, growth, and employment. Yes, it is a very dangerous time. But it is in dangerous times when we have to step up and take responsibility for our future.
And I see in some ways the connection between the mission of your institution and mine, which is about, in dangerous times, trying to get the world to understand itself better and deal with its collective challenges. One of those challenges is in the midst of a war situation. Sanctions, for example, pull apart the economy in some ways. And I wonder how you reflect on the impact of sanctions on the use of reserve currencies, which over time obviously are affected by many factors. But I wonder if your sense is that large countries that have reserves in dollars and euros, for example, are likely to have a pivot away from the use of those reserve currencies as a result of the sanctions.
Well, let me first state the obvious, that the root cause of what we face today is the war. And it is the war that must end. The sanctions are a reflection of a global order that has been severely impacted. Look, I have never thought that I would live to see another war in Europe of the magnitude of the tragedy that is happening in Ukraine. So our attention, and I know for Carnegie this is natural, has to be on the war must end. When we look at composition of reserve currencies, we have to rationally analyze why countries decide to hold some currencies and not others. And the reason is that these are currencies of countries that have deep capital markets, that have strong institutions, and are reliable in terms of what policy directions they would take. When in the last decades, there has been some pivot towards other currencies, and the share of dollar in reserve currencies declined from 70% to 60%. 3/4 of this 10% shift was to other smaller open economies with strong fundamentals like the Australian currency or the Swiss franc. So it has not been towards currencies that may not have that key fundamental of strong institutions, predictable policy framework, and above all very deep and vibrant capital markets. What I think the biggest change is going to be is how digitalization of money impacts our world. Over the last years, there has been this process of increased digitalization with crypto assets, stable coins, central bank digital currencies. The pandemic put this on steroids. So now we see a much faster advancement in that direction. And we already have the first central bank digital currencies. Surprisingly or not, the very first one was the Bahamas sand dollar. That process is going to create new dynamics around the global financial system. And it is very important that we are focused on what would it take to protect financial stability. Well, in terms of central bank digital currencies, interoperability. Can we still be integrated with new central bank currencies coming forward? For stable coins, it would be, are they regulated in a way that they protect the people and businesses? And for crypto, the use of Bitcoin and others, again, it would be a matter of, do we know exactly what is happening, how we can integrate these transactions into a global platform? So there is a lot of work to be done. And I want to stress it is not just the war, it is also this fast-moving train of digitalization we need to be mindful of.
And in some ways, those challenges, which are new, are reflective of the broad range of issues you have to deal with at the IMF. You also have to deal with persistent challenges we've had for a while, but that are in fact in some ways getting worse. So I'm thinking about supply chain challenges and particularly the food economy, which you mentioned in the outlook. Now that the Ukraine crisis is affecting global food supplies, given the amount of wheat produced by the Ukraine and Russia, what can we do to help countries that are dealing with food insecurity? I recognize from your economic outlook that a very large proportion of developing countries are already facing food insecurity and scarcity and inflation in the food economy.
Well, you're absolutely right. The Russian invasion of Ukraine triggered spillovers through three main channels. The first one is commodity prices, wheat, oil, gas, metals. The second one is pressure that is put on inflation and the necessity for central banks to tighten up faster than they would have done otherwise, with all the consequences for emerging markets. And the third one are the financial channels, remittances, but also the impact on how the monetary system is going to look like after the war. So when you look at this impact from a human standpoint, the most dramatic one is indeed food prices. Why? Because that comes on top of already deepening food insecurity in many parts of the world. Remember, we had bad harvests in a number of countries, locusts in Africa, in the Horn of Africa. That all has already generated pressures. And now the war is hitting on the poor families of the world even more. So what can we do? We put out a joint statement with the World Bank, World Trade Organization, and the World Food Program. There are two things we can do to help. The first one is coordinated action. Provide preferably grants, provide financial support to countries so they can procure food for their people. And two, avoid trade restrictions. If we do not allow food to flow from one place to another, the global food situation would get worse. But that is not on its own enough. We have to think about agricultural productivity in a world of changing climate. And we have to think about diversification of food production, because when we have more diverse sources of food, then food security goes up. It's a little bit like the vaccines. Mm-hmm. If you are concentrated only in 1-2 places, then inevitably part of the world is not covered, so produce more vaccines in Africa. The same applies to food supplies. In a shock-prone world where climate change is going to impact agricultural productivity quite dramatically, we ought to invest in this resilience so we are not dependent on luck, but we are actually strong in how we support economies. What we do at the fund, we look at the balance of payment impact of rising food prices, and we work with our partners to make sure that there is strong defense against this very dramatic development.
This is an example of the short-term and long-term intersecting. In your remarks, you were mentioning how changes in technology, which we have foreseen for decades, really are now hitting the labor market, affecting innovation, affecting security, affecting finance. And in similar fashion, I get the sense that your analysts, your colleagues, and you are highlighting for the world how we've been talking about climate change for generations. It's here. It's affecting families all over the world. It's exacerbating global inequality. And that highlights to me how, in some ways, the pandemic and climate change, though they are different, they highlight some similar themes. And inequality is one of them. So the economist Joe Stiglitz has pointed out that during the course of the pandemic, billionaires around the world have added $4.4 trillion in wealth, while 100 million more people have been made poor. And I wonder how you think about what that means for your institution, for the world, for global peace. What do we do about this long term, not just in terms of the shock that the pandemic represents, but thinking about the structural realities that affect billions of people around the world?
Well, the sad reality is that during the pandemic, inequality went up. And who was most impacted and continues to be most impacted? Low-skilled workers, women, young people. Why is this something that everybody should be concerned about? Because it affects the social fabric on which prosperity and peace depend. If you go back to the year before the pandemic, 2019, it was a year of protests. People were on the street, mostly because of inequality. What we are seeing this year is some of this spark of protest again coming. What can be done? Well, one, we have to find a way to distribute the benefits of globalization and growth more equitably. And for this reason, the fund has been advocating for quite some time a more proportionate tax system that allows education, health, social protection to be funded for the sake of future growth and productivity, not only because it is morally right. We are also very focused on understanding more granularly inequality. What is driving it? And one thing that is very clear is that inequality of income, very bad. But what is really tragic is inequality of opportunity. Giving a chance to every child to learn, to go to school, to actually start from preschool, and to learn and have job opportunities, investment opportunities is critical. Access to finance, especially access to finance for women, essential to address inequality. I'll give you a small anecdote I learned in Africa, that in Africa, data shows that women are better entrepreneurs than men on the basis of performance of their businesses. But they have 6 times less access to finance than men. So addressing inequality, the income is the residual, but access to assets, to finance, to opportunities, is what can change societies and make everybody better off.
I want to emphasize some themes in what you just shared, because it's really striking to hear a managing director of the International Monetary Fund discuss with such passion and clarity issues of equity. You are highlighting the connection between economic stability, the mission of this institution, and equity, and also between the macro level questions that affect drawing rights and financial flows and economic stability globally, and the micro level questions of who has opportunity where. So I worked in the Treasury in the late 1990s, and I must say it is fascinating and quite interesting to hear the managing director of this institution now sound a very different note that perhaps we might have heard in the late 1990s. And I'm struck also by the fact that you grew up in a developing economy, and here you are representing a whole variety of perspectives in this role. That leads me to ask you about international institutions. There is almost a paradoxical quality to our discussions of globalization, international institutions. Obviously, this is not a time of economic prosperity for everybody. But if you do take a perspective that is over decades, and you mentioned this earlier, Managing Director, billions of people have had their lives improved. We're talking about a decline in extreme poverty around the world from about 45% in the 1980s to less than 10% now. Life expectancy is longer. And yet there's distress, there's disaffection, there's a lack of comfort with the way institutions currently work around the world, domestic and international. I wonder what you make of that paradox and what that means for your agenda here at the International Monetary Fund.
Well, let me first say that I am very fortunate to be at the IMF at exactly this time. Why? Because I do bring a perspective of someone who lived through terrible economic time that was due to bad policies. And it was the IMF that came to my country to help it deal with hyperinflation and put a sound foundation for growth. So when we are now faced with inflation, to me, this brings back memories from the time when my mother's lifelong savings disappeared in 48 hours. And I know that good, sound policies are important not just for the technical term of macroeconomic financial stability, but for the lives of people. And that this is what policies are about. You know, we make macro decisions, they have micro consequences. When I think of our institution, the IMF, at this moment in history, what we offer is not just the high competence of our economists, but proven track record of being a learning institution. We have transformed through our history from the days when we had the gold standard to afterwards, to the times when the IMF integrated the former centrally planned economies and helped them take a very successful pivot for many of them towards higher standard of living, to today when we are faced with tremendous present urgent challenges caused by the pandemic and the war, and the longer-term transformation that economies need to adjust to a more shock-prone world. What does it mean for us? It means that we have to rethink the concept of economic resilience. Remember the global financial crisis? We came out of the crisis and we said, no more we can have a banking sector that is not based on sound data and doesn't have the buffers and security to perform. Now we have the benefits of reforming the banking sector because in this crisis, it has been very resilient. Good, not good enough. We have to think of resilience in a much more comprehensive way. Resilience of people that are educated, healthy, they have social protection, a cushion to fall on in difficult times, resilience of our planet, and the resilience of society, which is about productivity, growth, and price stability, but it is also about fair access to opportunities and a chance for everybody to reach their full potential. And that is where we are thinking of our future as an institution, how we can expand our horizon, one, and two, how do we work with others? We don't have to have all the skills and all the answers, but we have to be a building block in this more resilient world we have to build.
Thank you. And as we reflect on what this means, not only here in Washington, D.C., but around the world, we're going to take some questions from a global audience. And the first one comes from Trin Nguyen, who's a scholar in Hong Kong.
Policymakers had to ease aggressively fiscal and monetary policy in response to COVID-19 shocks. But with developed markets recovering, especially the US, normalization of policies are happening, with emerging markets having to deal with both tightened external liquidity, higher inflationary pressures from supply shocks, and debt sustainability. Which countries do you think are most vulnerable, and what tool and support does the IMF have to help emerging markets dealing with inflation, growth, and debt sustainability dilemma? Thank you.
This is really a very, very pressing question. The pandemic got an international response that was at par with the challenge it presented. What happened was we had to bring the economy to a standstill. Producers don't produce, consumers don't consume, don't buy things. We did that, but only because central banks and finance authorities were very fast in a coordinated manner to provide the fiscal support and the monetary policy accommodation to retain our societies more or less intact. And not only that, but to increase spending for health, for vaccines, for treatment, for medical workers. So that was the right thing to do, but it has consequences. And one of these consequences is an increased level of debt. 2020 is the record highest borrowing year since the Second World War. Even the global financial crisis didn't lead to, in 1 year, such an expansion of borrowing. Now, when we have that level globally at 256% of global GDP, obviously, we have to think of the impact of it. When interest rates are low, in some cases even negative, this is easy. In fact, in 2021, debt went up, but debt service in many countries went down. Why? Because of accommodative monetary policy. When inflation accelerated, and I should say that part of the pressure on inflation came from demand picking up after the pandemic, but supply chains being broken and supply not catching with this demand. Today, also because of the pressure of war. Price stability is very important for growth. So central banks do have to take action. They have to act decisively. When they do so, interest payments go up. Servicing debt becomes much more difficult. For whom it is more difficult? For poor countries that have very little space, fiscal space to act. And now we see two pressing needs. One, for countries that are already in debt distress, where debt is not sustainable, it is important that actions are taken to restructure this debt early. We have the common framework that during 2020 was initiated, and rightly so, to bring all creditors, public and private, together. It has promised, but it has not quite yet fulfilled this promise. That has to happen. And two, we are telling countries, look at ways in which you can ease this burden of debt. Can you stretch maturities? Can you switch currencies in a way that allows you to be protected against exchange rate pressures that may come? Do it now. And of course, the IMF is there. We have $700 billion to lend. This is a war chest. We will not hesitate to deploy it.
The next question comes from Zainab Usman, who is the head of the Africa program for the Carnegie Endowment and a development economist.
My name is Zainab Usman. I am the director of the Africa program at the Carnegie Endowment for International Peace. My question is with respect to climate change. African countries are only responsible for 2.7% of cumulative greenhouse gas emissions, but they are disproportionately impacted by the effects of climate change, with an estimated $38 billion in economic losses from severe weather alone. Between $30 to $50 billion is needed each year over the next decade to put in place climate-resilient development and adaptation mechanisms in Africa, and most African states face severely constrained fiscal options. How can the IMF better support African countries to respond to the climate crisis? Are the IMF's existing instruments sufficient and capable of responding to these large climate finance needs? In particular, is there any scope for financial innovations by multilateral lenders like the IMF to these countries in adapting to climate change without adding to their large debt portfolios? Thank you.
Excellent question. So you really have fantastic stuff. So Zainab, let me recognize that Africa has contributed very little to the problem of climate change. And yet, it is on the receiving end already of dramatic consequences. It is absolutely paramount that we prioritize adaptation and resilience in climate programs in Africa. And I do hope that when the world gathers in Egypt for COP27, this being in the African continent, will focus more attention on adaptation. What can the IMF do? We have shaped up a strategy for climate action that our board approved. And what it says is that the IMF will prioritize in our policy engagements mitigation in countries that are large emitters of CO2, adaptation for countries that are highly vulnerable, many of the African countries are, and transition for countries that today rely on hydrocarbons, but they need to move away. And we know in Africa we have producers of hydrocarbon. So when we take our responsibility, what it means is we search for solutions that are appropriate for Africa. One, we look in ways in which Africa can generate revenues on the basis of programs that help adapt and also reduce emissions. Let's take, for example, the Congo Basin. Forest there absorbs 3% of global emissions, almost as much as the African continent is producing. We have to make that a source of revenues, and this is what the IMF is very good at, to look into ways in which fiscal positions of countries need to be strengthened. What would be key? Good governance, because if we cannot trust what is being done, it would get undone. And we have ideas for mangroves restoration projects, for reforestation projects that can help Africa adapt and improve agricultural productivity and at the same time create revenues. Two, we are very keen to use our new instrument, and you might have heard me talking about that, Resilience and Sustainability Trust. For the first time in our history, we have a long-term financing instrument for structural transformation, and we are prioritizing the climate transition, low-carbon, climate-resilient economy in the use of this instrument. We are going to have about between 30 and 50 billion, and my colleagues working in Africa are already identifying countries that can benefit of tapping into this instrument. But public money is not going to be enough. So the IMF is working with partners to see how public money can remove obstacles for private investment on scale. And there, what I'm going to say is not going to surprise you. The stronger are the economic fundamentals of a country, all other things equal, the more attractive it would be for private investments. And that is the bread and butter of the IMF, helping countries to have sound financial systems and trustworthy data when it comes down to how they use their resources. In other words, good governance.
And I'm going to make an analogy there. I sense both an interest in innovation and what you're describing, as well as a deep consistency with the mission of the IMF long term. And in that respect, I would just note that our mission on global peace and cooperation is both reflecting a degree of innovation and continuity when it comes to a new sustainability and climate program that we're starting.
Yeah.
Our last question comes from Sahil Lauji, who is a junior fellow at the Carnegie Endowment.
My name is Sahil Lauji, and I'm from Atlanta, Georgia. I recently graduated from Harvard with a degree in government and international relations, and I'm currently a Gaither Junior Fellow at the Carnegie Endowment for International Peace. My question is, we have had a tumultuous past few years, a persisting pandemic that has uprooted plans, futures, and dreams, promised climate action that feels too little, too late, and forsaken racial justice, humanitarian crises, and destructive wars. Are there any economic areas for hope for young people? Does this moment present an opportunity to align our economic systems with humanity's profound need for a more just and fair global society?
Yes. And the hope comes from our human history. We make mistakes, but we also correct them. And we have succeeded to overcome tremendous shocks in the past. We will succeed again. I have high hope in the young people, in you, and congratulations, by the way, for you graduating from Harvard. That's not a minor thing. Because you have the opportunity to write on what is going well, and this is technological advancements, innovation, creativity, but do so with a strong sense of social justice and demand from our generation to do our part. I have a favorite saying, Maya Angelou, my favorite writer, and she says, do your best until you learn better. And when you learn better, do better. So embrace that notion that we can and must do better.
I want to emphasize as we close, Cristalina, thank you for a terrific conversation, that that quote from Maya Angelou is connected to a point you made earlier about a learning organization, trying to lead a learning organization. I get the sense that you and your colleagues are handed a world that is imperfect, difficult, complicated, uncertain. And what I appreciate about this economic outlook is you do not sugarcoat that. You're honest about the challenges the world faces. You're honest about both the limitations and the capacity of the IMF to do something about it. But at the heart of the strategy is the commitment to learn, to do better over time. As I think about the 1990s and now, I sense a learning curve that I admire and I hope to replicate in my own institution. And I wish you and your colleagues well as we continue to confront these issues together. Thank you.
Thank you, Tino. It was fantastic to engage in this conversation with you and fellows.
Thank you.
Thank you.